My risk is 8 big ticks. My payout is 15. Am I happy with that? And if I'm happy with that, great. If I'm not, don't take the trade. And it's that simple. I'm not looking at what the risk reward is. Simple question and answer. Am I happy with that? Is my stop where I am wrong on this idea at this point in time? And is my target realistic? And if you've answered those questions, you know where your stop should be. You place it, you accept the risk before you get into the trade, accept that's what you might lose, and you let the trade do its thing. What should I focus on improving? This is a classic question. Should you improve win rate? Should you improve risk reward? What skills should I develop? Right. Win rate and risk reward, I think, are two of they're not the worst, but they're not good metrics, and they are extremely difficult to realistically improve. So let me give you an example. Win rate. On the left is win rate for our best month of the year, win rate for our worst month of the year. They're virtually the same. The point here being, it doesn't matter how many trades you're making and losing on, it's what the scale of those winning trades is. So win rate is actually a very, very weak judgment of performance. And let's be realistic about win rate. Markets are essentially random on the basis that when you enter a trade, the market will go up or go down. Therefore, it's 50-50 roughly. And that bears out in the win rates. Very few people can achieve a very high win rate. In fact, I would be inclined to say I don't know anybody who's got over a 55% win rate. And let's think about the reality and the logic of this. If you've got a higher than 55% win rate or 50% win rate, this means that on average, you're more right than everybody else trading that market on average over time. Now, when you put it that way, it doesn't sound massively realistic. Now, I'm not saying that some people don't achieve this, but I've read something from Steve Cohen, First Point Capital's, the owner of First Point Capital, who says that his best traders have a 55% win rate. A win rate is not a good metric. Anybody who says you can improve your win rate, I think, to be honest, is lying. If I had an 80% win rate strategy, what I would be doing is leveraging that up to the absolute maximum. If I had an 80% win rate strategy in the S&P, I'd be trading 10,000 lots. I wouldn't be trading 2 lots or micro lots or anything like that. You'd be trading as big a size as you could possibly put through that market if you had that level of win rate. Nobody does. So win rate, get rid of that. Realistically, what you want to be looking at with win rate is it should be around 50%. People can skew their win rate. You can skew your win rate positive by not getting out. And then most of the time, yes, you might win because you just don't get out. And then when it goes just on side, you get out. But when those trades go wrong, essentially you risk everything for a small winner. That doesn't make sense. Risk reward then. Let's go and have a little look at an example of risk reward. Now, I know so many people say, oh, you want to have this risk reward, this risk reward, this risk reward. No, you don't. The level of risk reward you have to judge is you have to say, right, my stop is here, my target is here. Therefore, if I enter here, that gives me a certain amount of risk reward. True, but it's very difficult to always get. And think about it like this. Let's take this example. You buy the breakout entry at 25. So buying at 25, you've got the target. Buy at 25, target's at 40. That's the high of 2 days ago, 3 days ago's cash session high. There's your target. You stop, you want to make sure you're down below this high, which was the previous day's regular trading hours cash session spike back in the afternoon. So that then gives you an 8 big tick stop for a 15 big tick target. So let's call that roughly 2 to 1. This trade doesn't have to work out, of course. So let's take this example here. You're looking for this breakout. This gives you a 2 to 1 risk reward. Now, if you want to improve the risk reward on this trade, how do you do it? Well, there's one of 2 ways you can improve this reward. You can look for a smaller stop, or you can look for a bigger target. They're the only 2 ways you can do it. I don't think there's any issue with small risk rewards as long as the probability of the play out or the probability of the trade working is high. And that comes down to how you manage your stop. Right, so risk reward. What you could do, this is the actual move on a 1 minute chart. So that was the previous, that's the half an hour chart. This is the move on a 1 minute. Now, you could make your risk reward smaller. When you buy the breakout up here at 25, you could put your stop below this most recent high at 22. That is the top of this red candle just here. Now, you could do that, or you could leave it down at 17. If you move it to here, that gives you a much better risk reward. You're risking 3 and you're on for 15, 5 to 1. Yes, people like the look of that. The problem is that, and what you've done, you've given yourself a better risk reward, but you never got paid. So that's the problem with that. You can give yourself good risk reward, but if you don't get paid on it, it doesn't really matter. So the other alternative is you could give yourself a bigger stop. A bigger target. You could keep the same stop at 17, but because you don't really want a 2 to 1 or less than 2 to 1, give yourself a bigger target. And the S&P doesn't do it. If you bring the S&P in now, this is where we are. So there's that same trade. Just make that chart a little bit smaller. There's the move. There's the break back down below 22.5, move to 40, and it rolls all the way over, meaning that you would get stopped out on the 22s or the 17s. So you can't just give yourself bigger targets to improve risk reward. The other thing as well, trades that you take on, you know what the trade is. The target is the target. So the way you've got to think about that, a harder thing to do in trading is to give yourself bigger targets, because that implies that you've got to learn a whole new chart, a whole new skill set. You can only take the trade for what the trade is. In terms of criteria for using for stops, simple question. Where are you wrong? That's it. Dead simple. Not asking any more questions. You ask yourself, where are you wrong on this idea? And then you ask yourself, am I willing to lose that much money for the payout that I'm going to get? That's it. So risk reward doesn't come into it. Risk reward is just a way of measuring your potential upside relative to your downside. So in a situation like this, we've moved up, you buy the breakout at 25. You've got a little pocket of low volume, which is helpful at 20. You've got that previous level at 17. So I can then say to myself, right, my risk is 8 big ticks. My payout is 15. Am I happy with that? And if I'm happy with that, great. If I'm not, don't take the trade. Then it's that simple. I'm not looking at what the risk reward is. Simple question and answer. Am I happy with that? Is my stop where I am wrong on this idea at this point in time? And is my target realistic? And if you've answered those questions, you know where your stop should be. You place it, you accept the risk before you get into the trade, accept that's what you might lose, and you let the trade do its thing. What you really should be looking at is leverage. This is one of the traders' performers in the S&P today. What you notice here, win rate 43%. So he's losing more than he's winning. But look at the size of the losses. The gray is the actual taken loss. So the red is the most down he's been on the trade. The gray is the loss that's actually taken. Look at, on average, these are all very small. Look at the size of the winners that are taken up here, up here, up here, up here, over here. That's what matters. It's about recognizing when the market starts to move in your favor, you add to the position. That way, win rate can be very flat. Risk reward is only useful when the market starts to move in your favor, because a trade can have great risk reward, but until it actually starts to move, you don't know that it's actually going to pay out. But once it does start to move, once it does show you you're right, then you add on to it. This way, the 43% of trades that he takes that win, yes, maybe they go a little bit further, but they're also being done on more size, adding as they go.